In this video, I'm showing you the 8 most common mistakes investors make. Welcome to the Finance Guardian channel, and in this video, I'm going to share with you some of the more common mistakes that investors make so that we can all avoid them. Number 1. No investment plan. Many investors make the mistake of entering the financial world without a strategy in place. They simply try to pick the best of breed. However, it is difficult for even the most seasoned professional to beat the market indices consistently or make wise decisions with money on a case-by-case basis. There are plenty of good value investments out there if you know where to look, but you'll find far more available opportunities if you start by focusing on your investment strategy. That way, you'll know what to look for and how the whole process of investing should fit together. Ask yourself, what am I saving for? How much risk can I take, and what is my preferred level of cash flow? How long will it be before I will need to access this money? All these questions need to be answered before you start to invest your hard-earned money. Of course, these questions are not as easy to answer as they seem. For example, the answers that everyone gives now is that retirement is a long way down the road and so risk can be taken. The next question should be, how much money has been saved for this goal? Many people get caught up in the media hype of inflation and think they are saving enough, but what level of inflation do you think will be experienced during that time? The other question that should be asked is, are there any other mitigating factors that will affect this plan? The answer to this can vary depending on who you ask, but let's look at some of these factors. The stock market performance in the interim period. Will this help or hinder your plan? Will you need access to the funds before the term of this investment, and if so, how much will you need and when will it be needed? Will you need to pay tax on the income earned or on the capital gain if any was made? Will this money be needed for something other than retirement, such as a house deposit or for education? These are just some of the things that can affect your plan. The last question is, what kind of return do I need to achieve? This varies with the type of investment. How much are you prepared to lose in any one year or overall during your lifetime? This is called risk tolerance. Many people have only a short time before they will need access to their funds, so income may be very important, so start with a plan. Warren Buffett has said, do not save what is left after spending, but spend what is left after saving. Number 2. Trying to time the stock market. The stock market is the second largest casino in the world. There are so many factors that can affect its performance, it's impossible to accurately call the best time to invest. Everyone wants your money when they have an investment plan, but you need to keep it away from them. Therefore, how do you decide what is the right time for you to invest? The biggest mistake most investors make is trying to time the stock market. It's impossible to call the top or the bottom of any given index, so why waste your money trying? For example, if you had decided that in March 2009 was a good time for you to invest in the stock market, then by November this year, the market had fallen by more than 20%. It would be easy to feel that you had made a mistake in listening to the experts and getting into the market. However, when you look at any 10-year period of stock market growth, it's anything but smooth. Timing your entry point will leave you without funds available early if left too late or out of the market when it is at its peak. Warren Buffett's advice on timing the market. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Number 3. Being impulsive. Being patient and keeping your position until it pays off is an important part of investing. Those who have been successful in investing have a long-term plan and strategy. It takes time for your money to grow, so don't be tempted to cash out early unless you really need the money. This is a sure way of taking a loss by selling at a lower price than you paid for it originally. The stock market has a number of ups and downs. You need to know how much you will need immediately and the rest at what intervals so that you do not miss out on any great opportunities. If you have some funds in the market for this long, your odds of success increase. Warren Buffett says, our favorite holding period is forever. Number 4. Focusing on cost rather than value. Many investors place too much emphasis on share price rather than what the shares are truly worth. The price of a share is influenced by many factors including sentiment, market conditions, and the overall economic climate. The value of a share represents its true earnings potential. When you buy shares in a company, you are acquiring ownership in that business. If your investments have done better than you expected them to do, it can be easy to invest more money in that sector or that particular asset class. This can be a mistake as it is not diversifying your portfolio, and if the assets underperform, then you will lose out on future growth. It's important to remember that what goes up must come down, and vice versa. However, some asset classes perform very differently from others, so keeping an eye on how they perform is important. Warren Buffett has made these 2 points public many times over the years. The first one, beware of geeks bearing formulas. The second, a low-cost index fund will outperform about 80% of all other investments because it simply follows market movements and does not try to outguess them like most professional investors. Number 5. Focusing on financial news. Contrary to common belief, there isn't much in the financial news that may assist you in improving your investing performance. In fact, it may have the opposite effect, as well as all of the information you're getting is from highly paid journalists and market participants who've been wrong countless times. In addition to this, most news channels operate on a profit motive that seek sensationalism over relevance and accuracy. The media's focus is mainly on short-term stock performance rather than long-term historical returns. The best way to invest is by not knowing too much about your investments. Warren Buffett has said that success in investing doesn't correlate with IQ. Once you are above the level of 25, what you need is the temperament to control the urges that get other people into trouble in investing. Number 6. Waiting for the market. A big mistake that many early investors make is that they are always waiting for a lower price. They will wait for this price instead of buying at the current market price. This is a common mistake that many investors make. They don't purchase the stock and therefore miss out on the potential growth. Instead of looking at entry points, you should look at exit points and make sure that they point to a profit. This way, you will be prepared, and if the company that you have invested in does not show signs of growth, then you can sell at a small loss instead of waiting for it to break even. Warren Buffett says, "The stock market is filled with individuals who know the price of everything, but the value of nothing." Number 7. Becoming part of the herd. While there is safety in numbers, but when it comes to the world of investing, you cannot let yourself become a victim of herd mentality. Herd behavior is the tendency to mimic others' behaviors, so you will often see more investors making decisions based on what other people are doing rather than their own research. This can lead to buying at the top of a market rise and selling at the bottom, so remaining detached from this type of thinking is a highly sensible decision. Before you invest in anything, you should do your own independent research. This will help you to make the smart choices instead of following other people's advice. One very common financial investment mistake that inexperienced investors make is turning over their investments too quickly based on others' decisions. Don't be swayed by these pundits. Warren Buffett has said, "What we learn from history is that people don't learn from history." Number 8. Looking for short-term gains. According to Buffett, his preferred holding term is forever. This means that he prefers long-term gains and waiting to quickly buy and sell stocks for a minimal profit. This is another mistake that many investors make in an attempt to generate short-term gains. The mistake that they are making here is that by chasing short-term gains, they end up losing out on the bigger profits that are within their reach. In investing, you should be thinking long-term and not short-term. If you are looking to make quick profits, then investing is not the right game for you. Warren Buffett says, "I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over."